Hi everyone, let's take a look at this problem where we're asked to calculate taxable income and then determine what the tax would be. So here's the problem right in front of you. It says in the current year, Tanager Corporation, a C corporation, has operating income of $480,000 and operating expenses of $390,000. In addition, Tanager, or Tanager, I'm not sure which it is, had a long-term capital gain of $55,000 and short-term capital loss of $40,000. Now, they gave you the tax rate schedule, that's down here, to use for this problem. And what we're supposed to do is determine the taxable income and the tax. Okay? So let's tackle part A. Here's the information provided. Operating income, operating expenses, long-term capital gain, and short-term capital loss. Well, all of that flows through to taxable income. Okay? And so taxable income is $105,000. Now, look at the notes that we have highlighted there. It says net capital losses of corporate and individual taxpayers receive different income tax treatment. Generally, individual taxpayers can deduct up to $3,000 of such net losses against other income. Any remaining capital losses can be carried forward to future years until absorbed by capital gains or by the $3,000 deduction. Loss carryovers retain their identity as either long-term or short-term. Okay? In our case, we've got the full $105,000 that becomes taxable income. Then, to come up with the amount of the tax, you go over to the income tax rate, the schedule that they gave us, and we know we had $105,000, so we're between $100,000 and $335,000, so it's $22,250 plus 39% of the amount over $100,000. So that's $2250 plus $5,000 times 39%. Add those two components, it's $24,200. And that's all there is to solve part A of problem 2-43. Okay, now I slid up so that we can show part B. And part B says, assume the same facts except Tanager's long-term capital gains was $15,000. Okay, well, if this was the case, then what happens is long-term capital gains, if we're assuming the information is $15,000, okay, that $15,000 would flow over to taxable income, but we can only deduct short-term capital losses equal to the amount of capital gains, so that would be reduced to just $15,000. Okay, and once we do that, we see taxable income would become $90,000, which is the correct answer, and the tax on the $90,000 would be $13,750. Now this time we'd be right above the highlighted line. $13,750 plus 34% times the amount over $75,000. And I should probably format that the same way, but let me do that. Okay, the screen probably moved a little bit, but anyway, you can see that becomes $18,050, and how I calculated that was the $13,750 taken from the tax table plus 34% of the $90,000 minus the $75,000 times 34%. And on the last one, we did the same kind of math. If I hit F2, you can see, oh, this one I just did $22,250 plus $19,50. I didn't even work the math out in that cell. All right, and that's how we would come up with the answer for part B.